In today's video, I'm going to give you 5 tips and tricks that you can use to avoid 2 common 401k rollover mistakes. Because nearly everyone will roll over a 401k at some point in their life, you're going to want to listen into today's video. Now, every worker will be faced with a decision in their financial life whether they should keep their hard-earned money in their 401k when they retire or separate from work, or whether they should roll that money out of their 401k into an IRA. This video will also apply if you have a 403b or a TSP account as well. Now, there are going to be valid reasons on both sides, whether to roll over or not roll over that 401k. And I'm not going to go through all of those reasons as it's a bit beyond the scope of today's video. But to summarize, most people will find it most beneficial to roll that money out of that company plan at some point during their life. The main reasons to roll out of that 401k are really all focused around flexibility. Flexibility of investing, withdrawing, or even using charitable strategies like QCDs. The main reason you might want to keep that money in your 401k for the long term is generally creditor protection. But there's a problem you will encounter when you decide to roll that money out of your 401k. With most investment accounts you have, you can do what's called an in-kind transfer. Say you roll an IRA from Vanguard to Charles Schwab. Well, you can keep the exact same investments through that transfer and have no changes when moving from one custodian to the other. Everything transfers, well, in kind. With rolling a 401k to an IRA, however, in-kind transfer is not possible. Instead, your 401k, which is likely fully invested, needs to go to cash. Then a check is written out, and then that check needs to find its way to that receiving institution, often making a stop at your mailbox first. Well, this is really problematic for 2 reasons. The first, while your money is transferring, that money isn't earning any interest and is missing out on performance in the market. Well, let's say it takes 2 weeks to transfer and the market is up 2% during that time. Well, heck, that can be a pretty costly transfer. Problem number 2 is more behavioral. Often I see investors making that cash transfer and now they're sitting with a big cash balance in their IRA. So often people get stuck in an analysis paralysis situation and don't know how to move forward. Should you reinvest that cash immediately? Should you dollar cost average in? What exactly should you do? This often compounds the missing interest problem. Now, the first thing I will say, and we're going to come back to this, try to avoid timing decisions as much as possible throughout this process. Yes, the stock market and economy can naturally go up and down, but we have to start with the base assumption that we invest and expect to grow our money through that investment. So time out of the market means we are expecting to lose out on growth. Yes, you could be lucky enough to go to cash, miss out on a decline while in cash, but if that happens, you are really just that, just lucky. I say that because we need to start at the assumption that we want to minimize the period of being out of the market as much as possible. So let's talk through the 5 ways you can do just this. The first is very simple, and in my opinion is a no-brainer. Most 401ks will allow you to overnight that check if you ask. Now, typically this will carry a small added cost, but is an immaterial cost in the grand scheme. Let's say that you're rolling over a $500,000 account and overnighting a check costs you an extra $15. Overnighting that check can get that money reinvested days or even a week quicker. A $15 expense on a $500,000 account is 0.003%. Compare that to missing out on a 1% positive move in the market, and it seems crazy to not overnight that check. Number 2, in most cases, you have outside accounts that you can use to minimize missing out on market performance. Broadly speaking, we should focus most on minimizing missing out on stock market performance as the effect is expected to be the greatest. Yes, it will cost you to miss out on earning bond interest by being in cash, but the expected cost is greater when comparing to stock market performance. Let's say we have a situation like the one shown on the screen, where you have a 401k you want to roll over, and you also have an outside IRA. Well, a short-term solution to equalize out stock exposure is to sell out of safety and fill in the stock exposure you have in your 401k. So in this example, you would sell out of $250,000 worth of bonds and buy into stocks to match that 401k allocation. At the same time, you would initiate that 401k going to cash and transfer. So across accounts, you maintain that $650,000 of exposure to stocks, and now the only interest you are missing out on is just that bond interest. Then once that cash arrives from that 401k rollover, You can fill back into bonds and voila, you keep the overall exposure consistent. The one asterisk here is be careful if that outside account is a taxable account, as there could be tax risks associated here. And by the way, you can stack more than one of these 5 tips on one another to minimize the issue further. For instance, you could use your outside accounts and overnight that check to minimize missing out on that bond interest. Number 3, that rollover doesn't need to happen all at once. Say you have an $800,000 IRA. For the next X number of weeks, initiate a partial rollover of $200,000 at even increments. This way, at only one time will you have $200,000 out of the market versus the full $800,000, which represents a much larger share of your wealth. If you have smaller outside accounts, this can be a great way that you can match exposures on a much smaller basis. Now, as with anything, there is a fine line here between going too far. I would not recommend initiating $25,000 partial rollovers, for instance, as that would take too long and probably be too much work. The time cost isn't worth it when we look at this level of an extreme. Number 4, if your 401k provider is an independent custodian like Fidelity, you can use this to your advantage for faster withdrawals. Often a 401k provider will mail you a check, and then you are in charge of getting that check to the custodian of your choice. Say you have a Fidelity 401k, but you want to roll over to a Schwab IRA. If you try to go directly to Schwab, you will have more time out of the market due to that mailing time. But what if you create a Fidelity IRA first? Often this can avoid any mailing needed because Fidelity can send that money or check internally, which means quicker reinvestment. Then once you reinvest that money at Fidelity, now you can do an in-kind transfer going from IRA to IRA. This can drop the time you are out of the market precipitously. Then finally, don't overthink or try to time the market on reinvestment. Think about it. Your 401k was already fully invested. Yes, the rollover forces you to go to cash, but this really shouldn't change that much. But some mistakenly feel they should dollar cost average back into their investments because of having to go to cash. If you think about it, how is this any different than having a fully invested IRA that you arbitrarily sell to cash and then dollar cost average back into the market? It would be crazy to do this with your IRA, just arbitrarily going to cash. Again, you want your money fully invested as much as possible. Given this, yes, it's annoying that you have to go to cash on a rollover, but your goal should be to get that money reinvested back as soon as possible. Don't get caught in analysis paralysis here, otherwise you are just timing the market but calling it something different. Missing out on days in the market can ultimately be quite expensive. You've all probably seen stats on missing out on the best days in the market, like the ones I'm showing on the screen. You've probably also seen the benefit of missing out on the worst days in the market. The problem is no one knows when good or bad days are going to happen. Here's something I often see during these rollovers. Say the market is booming and reaching new highs. Often people will be comfortable being out of the market a bit because they think the market is becoming overvalued. Well, often the market keeps climbing to newer highs and becoming, well, more overvalued. And your cash decision means you miss out on that upside performance. Or I see a situation like the current market we're in where things are pretty volatile. Maybe you got lucky and going to cash helped you miss out on some negative performance. Well, now you are second guessing reinvesting because of this volatility and concerns that the market is going to drop further. But as you can see from the stats on the screen, the problem here is that most of the best days in the market historically come during some of the worst periods of negative market performance, which makes sense as the market is rebounding quickly often. Count yourself lucky that you missed out on bad performance and reinvest hoping that you take advantage of the recovery. Either way, get that money back to work as soon as possible. And to add on to this discussion with a, let's call it a bonus tip, there are effectively 2 ways to roll over your 401k. The first is a direct rollover or trustee to trustee transfer. This means that the check from the rollover will be made out directly to your custodian. It may still be sent to you first, but the check will not be made out to you. This is the safest way to do a rollover and the avenue I would strongly recommend. The other route is something called an indirect rollover, and I really don't see a reason you would want to use this method. With this method, the check will be made out to you directly. Then the responsibility is on you to get that money in your IRA, and you have 60 days to do so. First, you can only do this transfer once in a 12-month period, so you can't do partial rollovers with this method. Second, if for whatever reason you miss that 60-day time limit, that rollover is recharacterized as a distribution, and becomes 100% taxable to you. With a large IRA, this can be a massive mistake as you lose that IRA status around that money, and now you have a huge tax bill in that given year. So make sure you are doing direct rollovers and not indirect rollovers here. So there you have it. 5 ways that you can take a normally annoying rollover process and minimize away the negative aspects of this process. If you are looking to learn a bit more about whether you should roll over your 401k or keep it where it's at, click on this video right here where I discuss 6 surprising considerations you should factor into your retirement plan. Click here to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching, and we'll see you in the next video.